The poor man's covered call is an options trading strategy that mimics the payoffs of a traditional covered call strategy, but requires less capital upfront. Here's how to trade the poor man's covered call. A covered call involves selling a call option against shares of stock you already own. This strategy generates income from the premiums received from selling the call option, but it caps your potential upside if the stock price rises above the strike price of the call option. Choose a stock that you believe will remain relatively stable or increase slightly in price over the duration of your trade. Look for stocks with options that have high liquidity and volume to ensure you can enter and exit positions easily. Instead of buying the underlying stock, you'll buy a long-term equity anticipation securities, LEAPS, call option. LEAPS options have expiration dates typically more than 1 year away. Choose a LEAPS option with a strike price close to the current market price of the stock. Sell short-term call options against the LEAPS option you purchased. These call options should have the same strike price as your LEAPS option, but with shorter expiration dates, typically monthly. Your maximum loss is limited to the premium paid for the LEAPS option. Your maximum gain is the difference between the strike price of the LEAPS option and the strike price of the short-term call option minus the premium paid for the LEAPS option. Keep an eye on the performance of the stock and the options in your position. If the stock price rises above the strike price of the short-term call option, you may be assigned and have to sell your LEAPS option. You can choose to roll the short call option to a higher strike price or further expiration date to avoid assignment. As the options approach expiration, assess whether it's beneficial to close your position or let them expire worthless. If the stock price is below the strike price of the short-term call option, it may be advantageous to let the options expire and keep the premium received. Understand the risks associated with options trading, including the potential for loss of the entire premium paid for the LEAPS option. Consider using stop-loss orders or position sizing to manage risk and protect your capital.